The following is a conversation with Joseph Brown, founder of Heresy Financial. Joseph spent nearly 5 years in the financial services industry and witnessed too many people paying high fees for bad advice. Heresy Financial exists to assist people in learning how money works so they can control their financial security. Joseph's YouTube channel, Heresy Financial, has over 186,000 subscribers and has accumulated nearly 30 million views. He is a return guest on our podcast. His first podcast was very well received, so we decided to have him back on the show to discuss a few specific financial topics that could have huge implications on the world in the near future. You are listening to the Co-Movement Gym podcast, where we inspire people to move and live courageously. If you are enjoying this content, please support our sponsors in the description. I thank each and every one of you for being on this journey with us. Now, please enjoy the show. Folks, listen up. I want to take a brief moment and thank our podcast show sponsors, Lombardi Chiropractic, Native Path Supplements, and Redmond Life. Lombardi Chiropractic has been my personal chiropractor for 10 years and has kept my body strong and healthy. Native Path Supplements are used by numerous co-movement clients and our coaching team here at the facility. I highly recommend that you try their chocolate collagen peptides. I was made aware of Redmond Life by one of our trainers here at the facility. He recommended I try Relight electrolyte powder. This supplement has dramatically improved my afternoon energy levels and overall hydration. I'd like to thank these three companies for providing outstanding service and products that make our society healthier and more resilient. Mention the Co-Movement Gym podcast when you call Lombardi Chiropractic, and not only will they treat you like family, they will provide a nice, enticing discount to all listeners. And use code COMO15, that's C-O-M-O 15, at checkout when shopping at nativepath.com or redmond.life and receive 15% off all your orders. Your support to our show sponsors assists in us paying for expenses and continuing to provide content we hope you all enjoy. Joe, welcome back to the Co-Movement Gym podcast. How you doing?
Very good. Thank you for having me again.
Yeah, buddy, I couldn't wait to have you back on. There's a lot of stuff that's happening, and you're my guy. So let's talk some money here.
Yeah, I'd be happy to.
So the bank failures, whether someone follows the financial world or not, I'm sure they heard about three major banks failing in the month of March. And I want you to explain to people in basic terms what happened. Why did those banks fail? Because I know a lot of people are scared. They're nervous, keeping money in the bank. And just curious to see, the behind the scenes of what happened with these big banks. The banks were Silicon Valley Bank, Signature Bank, and Silvergate Bank, right?
Yeah. I mean, so I don't get to use examples like this very often. So I'm going to take this opportunity, since I know the audience here is very into fitness, obviously. So what would happen if you took an otherwise healthy person and you put them in an exoskeleton suit, like permanently? Like you give them knee braces that are motorized and elbow braces that are motorized, and you subsidize all of their movements so that these these mechanical contraptions are helping them move all their joints. What would happen to the body in that case?
Well, it would just atrophy, get very weak, couldn't stabilize itself.
Right. There'd be no more need for those muscles to continue to work for themselves. They would atrophy. The body would become very weak, and the nature of a mechanical addition like that, eventually that's going to break, right? Because they're motors, they're metal parts, plastic parts. They'll wear out, they'll break down, and so you'll be walking along just like normal. You'll think nothing's going wrong, and then one of the motors will give out, and you'll topple over, and you'll break a hip because you've got no muscle to prevent you from falling hard, and you've atrophied, and so there would be a big crisis as a result for your body of trying to subsidize the entire system. And that's exactly what is going on with our banking system right now. It used to be the case, and when I say used to be, I mean like pre-central bank, so a few hundred years ago. You have a bank. People would put their gold in the vault. They'd get a piece of paper that represented ownership of that gold, and then they'd trade that paper for money. And that worked pretty well because you had a limited supply of money because it was still gold. You didn't have to pay for the transportation of the gold to make a purchase because the gold still sat in one place. All that you did was trade the ownership of that gold for a transaction. So that system worked pretty well until somebody decided to engage in fraud. So you had a bank that would say, hey, look, I've got a way to make money on this. I'm going to offer loans. And people will think I'm loaning out my money, but I'm just going to be printing new pieces of paper. I've only got 100 pieces of gold in the vault, but I'm going to make loans so much so that there are 200 pieces of paper out there. And all of them say on them, hey, this represents ownership of gold in the vault, but there's not enough gold for all that paper out there. And so the bank would get rich for a while until people caught on and got wise and realized it. And they'd go turn in their paper to get their gold. And then once they got their gold, they'll call up their family and they'd say, hey, now that I got my gold, you need to go get your gold. Very quickly, it spirals into a bank run. And in that situation, that's happened many, many times throughout history, classic bank run, that person running the bank will never run a bank again. Right, their reputation will spread far and wide. They, engaged in fraud. They stole a bunch of money, and nobody would ever trust them to hold on to their gold again. The second thing that happens is everybody who lost money to that scheme would never lose money to that scheme again in their life. Like if you put your gold in a bank and then you lost it, you would make sure next time that you were giving your gold to somebody who is trustworthy, or you wouldn't put your gold in storage, or you would just make sure that that the system that you were trusting was actually real instead of fraud. Mm-hmm. And so allowing that individual failure to happen actually made the whole system stronger because every bank realized, hey, now more people are going to be more careful about this because that bank collapsed. So now I need to prove that I have all the gold. So I need to strengthen my books. I need to make sure that I have integrity, that I am trustworthy. So it makes the whole system stronger because the incentives are all aligned. But instead of outlawing this, they nationalized it. They said, okay, we're going to scale the system up. We're going to create a central bank. And in order to participate in fraudulent reserve banking, or what they call fractional reserve banking, you just have to be a part of our system and you have to do it under the central bank. And that didn't solve the problem. It just scaled it up. And so within the 7 years of creating the Federal Reserve, our central bank, you had the biggest depression in our history, the Depression of 1920. And then after that fixed itself and we pulled ourselves out, a year and a half later, it just took 7 years again of building up that risk in the system to create the next biggest depression that our country had ever seen, what we now call the Great Depression. And so it just scales the risk up, and then the collapse is even bigger. So we'll fast forward because, we got to the point in 45 where the rest of the world didn't have any money. They had bought a bunch of stuff from the United States to fund their war efforts. And so America had a bunch of gold. And so the rest of the world didn't want to start over and say, hey, we have to rebuild and get our own gold. So they just said, we have our paper money. We'll make our paper money redeemable for dollars, and then dollars are still redeemable for gold. So the United States had this unprecedented advantage to be able to control the global reserve currency at that point. And so we just like every bank throughout history told the world, we have the gold. We'll give you a piece of paper that represents ownership of that gold, and at any time you can come get that gold if you turn in your paper. That's what a dollar was, for history up until that point, and then for the rest of the world after that point. And then so for 30 years, because this time it took about 30 years for the risk to build up in the system, because every time you scale up, it makes it the period of calm last longer because you have more room for that risk to build up in, and then the collapse afterwards is just worse. So you have 30 years of that risk building up in the system, and then finally central banks around the world realize, hey, there's a lot more paper saying it's redeemable for gold floating around than we think there actually is gold in the vault, just like every bank before it. And so the rest of the world started turning in their dollars to get gold, and that caused a bank run, and the United States had to close the gold window because we didn't have enough gold left to redeem all the gold claims. So it was just another bank run. And so it's important to understand that history because the way that banks operate today is literally no different There is no difference. The nature of being a bank means I take your dollars that you put in deposit with me, and I go do something with it, which is 99% of the time loaning it out or purchasing a previously existing loan. Most of the time, banks are doing that by loaning the dollars to the United States government. It's considered a risk-free investment, but it's a loan, so it doesn't mature immediately. It takes time for it to mature, whether you're buying a 1 month, a 3 month, a 5 year, a 10 year, a 30 year, whatever it is, there's going to be an amount of time before that money gets paid back. But you made a deposit that's called on demand. You made a deposit that said, I can come back and get my dollar at any time. They don't have your dollar. That's what it means to be a bank. And I think a lot of people are starting to realize that now, that that's how the banks work. That's how they've always worked, and that's how all banks work. The big issue right now is that if you look at the price of the assets that they bought, or saying it another way, the interest rates of the loans that they made when they loaned out your dollars, a lot of that was over the last couple of years. Interest rates were at the lowest rates they've ever been in history. And so they were taking your dollar and loaning it out for, 0.1%, 0.5%, 1%, 1.5%. And so number one, that's really low rate. They don't have a lot to pass over to you. But number two, now rates are a lot higher. And when rates go up, it makes the value of that old debt lower, because that old debt is paying a lower rate. And so nobody wants that low rate debt anymore. So the price has to fall to adjust for market expectations, because the new debt is paying out a higher rate. And so in order for equilibrium to happen, in order for there not to be, an arbitrage situation, the value of that old debt goes lower. Well, if I'm a bank and I took your dollar and I loaned it out for 0.5%, now the value of that debt, if I need to sell that debt, it's worth 70 cents on the dollar. And all of you try and go get your dollars and say, give me my dollars. I have to go sell all those loans for 70 cents when I paid $1 for them. And that means only 70 of you are getting your dollars back. The other 30 are not. And that's how all banks are right now. That's how all banks operate. So it's important to understand, it's not that these banks like Silicon Valley Bank were making risky investments. They weren't. It's not as if you can hedge your entire portfolio. You can't. And so there's nothing out of the ordinary they were doing. It's just the nature of being a bank in a fiat monetary system, that the dollars coming in were loaned out, and then everybody tried to get them, and they're not there, and so they have to sell the assets to provide them, but the assets are worth less, so they don't have enough dollars to meet all the redemptions.
Why did so many people request their money all at once with these banks? What brought that on?
Part of it is a self-fulfilling prophecy. And so, when there's risk that everybody's going to try and pull their money out, then everybody will try and pull their money out, but they'll try and be the first one. And in doing so, now you realize the risk that everybody's trying to pull their money out.
Gotcha.
Specifically with Silicon Valley Bank, the issue there was the fact that so many of the deposits were large deposits. So this was a bank that dealt with, tech companies that over the last couple of years have raised a bunch of money. And so this wasn't a bank primarily made up of people with, a couple $100 in their checking account. This was a bank primarily made up of large corporate accounts that had hundreds of thousands to hundreds of millions of dollars. So that meant that I think the number was like 89 or 87% of the money at Silicon Valley Bank was above the FDIC limit. So if you have up to $250,000 in a bank account and the bank fails, the government has guaranteed that you'll get your dollars back. They'll just show up in a different bank account at a different bank. If you have anything over $250,000, then there's no guarantee on that. You may get it back, you may not. And so this meant that basically everybody at Silicon Valley Bank was looking at this and thinking, hey, if there is a bank run, none of us are getting our money, because it's all like, we've got hundreds of millions of dollars there. And so I need to be the first one to get it out. And then the last piece was just the underwater nature of the balance sheet that I explained earlier, why they take the dollars and they loan them out. And so whoever was the first one to notice this was like, hey, look, banks are at risk of bank runs. they don't have enough assets to meet all the redemption requests. And if a bank run starts, none of us are getting a bailout. So I'm going to be the first one to get my money out, and then I'm going to tell all the people I care about to get their money out. And then that causes the bank run to happen.
Why do you think they didn't diversify banks? Like just meet that 250,000 max for the have the insurance and then spread it out throughout other banks. That seems sort of like an easy strategy.
Not for large corporations, not for tech
Okay.
companies. When you're dealing with like hundreds of millions of dollars, and
Hmm.
you're sending in $1 million and
Sure.
receiving $1 million at a time, it's like you
Sure.
can't realistically do that if you spread that out across.
Sure.
There's not enough banks out there to do that.
Yeah.
Now,
See,
larger
I'm
companies, what
thinking.
they're yeah, go ahead.
Yeah, I'm just thinking. Yeah, like individual families, like that kind of stuff. But you're talking, yeah, mega big companies. Yeah.
Yeah, and that was specific to Silicon Valley Bank. So yes, there are now larger companies. Every one of them is saying, "Hey, we need to spread out through 5 or 6 different and of the big banks." So we'll have Chase, we'll have Bank of America, we'll have Wells Fargo, we'll have Citibank, we'll have spread out our corporate accounts, but there's still hundreds of millions in each one. It's just
Mhm.
spreading it out a little bit. But for individuals, absolutely, if you've got a net worth of $10 million, well, you definitely shouldn't be all in cash. So maybe you've got 500,000 to $1 million in cash, and then if you only have $1 million in cash, then yeah, you can spread that out through 4 or 5 different banks, and then you're solid.
Mhm. Are more banks in trouble with this strategy right now, you think, or no? Because we really haven't heard anything since then, or at least I haven't.
If you look at one of the markers is how many banks or the dollars that are being used at the discount window at the Fed. So in order to stop the bleeding, like Silicon Valley Bank, what they were having to do is they were having to sell all their assets to meet all the redemption requests.
Hmm.
And so what banks can do instead of doing that, they go to the Fed and they say, "Hey, I don't want to sell this on the open market. So can I give this to you as a temporary loan, like a pawn shop? Like literally, it's a pawn. So can I pledge this collateral to you? I promise I'll buy it back in the future. You give me the cash for it so I can meet these redemption requests." And the discount window, the reason why banks weren't using that is because they take a haircut on that, so they don't get the full value. So what the Fed did after Silicon Valley Bank was they opened up a new thing that was similar to the discount window. It's called the Bank Term Funding Program, BTFP, or Buy the Effing Pivot. And they take this facility, and instead of offering a discount, they actually give banks full price. So I buy an asset for $1. Right now it's worth 70 cents. So if I sell it, I'm taking a loss. If I go to the old discount window, I can only get, let's say, 65 cents for it.
Hmm.
But if I go to the Fed's new BTFP, I can get the full dollar for it. Now, it's still a loan, and I still have to pay it back, but I get the full dollar for it. That way I can meet all the redemption requests, and I don't have
Hmm.
to, worry about becoming insolvent. The problem is that's only available for like what they call high quality assets, like, treasuries. And so you can look at the usage of both of those. And when you look at the usage of both of those, they've come down a little bit since this whole thing started. And so it seems like in opening these up, people just said, okay, well, like I don't have to move my money out. That remains to be seen how many more banks are at risk. Like First Republic Bank is one that is still like heavily under fire and losing a ton of deposits, and trying to raise money, and so that one will probably fail. There's
Hmm.
one Pacific West or Pac West Bank Corp. I think that one is at risk as well. So there are small and regional banks that are under stress everywhere. The other reason for this is not just depositors like you and me pulling our money out and going to Chase. It's like the commercial real estate thing is big right now. Commercial real estate is all variable loans, so it's like 2008 all over again, but with commercial real estate instead of individuals and houses. And so all these rates are adjusting higher right now. Companies can't pay the higher rates. They can't refinance because the new loans are higher interest rate, and they can't sell the properties for what they paid for them, because nobody's going to the office right now. So all these office buildings are empty and rates are higher. So the prices are lower. So they can't get rid of the property. They can't refinance the property, and they can't afford the balloon payment. And so, it's the old saying, if I owe $1 million to the bank, I'm in trouble. If I owe $1 billion to the bank is in trouble. And so all these commercial real estate loans, they're making small and regional banks have to, consider taking big losses, or just accept the default and not get anything back, and go to the drawing board. And so they're under stress right now for sure.
Yeah, that's a great explanation. Yeah, that is put in terms exactly how I understand it, and hopefully our listeners. So for the most part, most people are safe up to the 250,000. Obviously, if you're playing over that, I would recommend probably spreading that out a little bit.
Yeah,
so
yeah,
let's so
absolutely.
yeah, let's move on. The BRICS nations. Who and what are the BRICS nations?
BRICS is an acronym. It's Brazil, Russia, India, China, South Africa, and now people are commonly including Iran, Saudi Arabia, Turkey, and a few other countries in this broader new economic alliance, largely Eastern, and not as much Western friendly. Now, I assume you're bringing them up because of the talk of a new international currency.
Yes, correct.
Okay, so there are a couple things going on. On one hand, you have isolated, tiny occurrences of de-dollarization that keep on happening over and over and over again. It's like every couple of days we see a new thing that's like, hey, there's a little tiny bit of de-dollarization that happened there, but it's consistent. It keeps on, like, it's, oh, there's another one, oh, there's another one, oh, there's another one. Like 3 days ago or 2 days ago, Argentina just announced that they're going to be buying all their imports from China in yuan. They're not going to be using
Mhm.
dollars to pay for them. They're going to be using yuan to pay for them. Now, so that's one little tiny thing, because it's Argentina and it's just their imports from China. And you could even point to the fact that the reason that they're doing that is because they're running out of dollars. So they're like, what can we do to like keep and save more dollars? It's like, stop paying them to China. And so there are all these little tiny things that keep on happening. There's Brazil just announced trade that goes between them and China is denominated in yuan instead of
Mhm.
dollars. We see talks between China and Russia and other countries about establishing a new currency that's just for international trade between the BRICS nations. And that currency would be redeemable for a basket of commodities like gold and oil. And therefore, the value of that currency would be dependent on the value of the basket of those commodities. We haven't really actually seen any traction in the in moving that direction. There's so far in the last 3 years, I would say there's a lot of talk, increasing talk, and little action. But it's just like it's like a slow drip, like Chinese water torture. It's just like over and over and over and over again. And eventually, when you have the global reserve currency, it gives you a lot of power over other nations, but every time you use that power, it takes away some of that power.
Mhm.
And sanctions on Russia are a perfect example of this. It's like, yes, the sanctions are probably have a net result of hurting Russia when you take all things into account. But at the same time, it's like now a lot of nations have been forced to figure out how to do international trade in energy and food without using the dollar. So it's like every time you use that privilege, it's like, well, now there's, we're pushing people away from using the dollar, which means we may not be able to have as powerful of sanctions again in the future.
What happens if it falls off as the main currency for the BRICS nation? What happens to the US dollar? Does it still exist? Is it just worth less? Like, I don't know how that works, It's obviously, how long has it been the main currency for BRICS nations?
Well, starting in 1945, it became the global reserve currency. And that was because of the Bretton Woods Agreement. So after World War II, all the major nations around the world had no money left. And at that time, money was gold. They had spent all their money to finance the war. And largely, most of that came over to America. So at that time, America had basically the entire global stock of gold. And so at that point, that's when the dollar became the global reserve currency because it was gold. And really, that marks a huge difference because prior to 1945, every country's money was gold everywhere. Every country just had their own currency that was backed by gold. Even before the United States became like a big global power, before the Federal Reserve, gold was the reserve asset, and it was just whichever nation, like the UK before the United States, kind of issued the currency that was most commonly used, but it was again still the gold that gave it the value. So 1945 was like, okay, well now this piece of paper printed by the United States is the paper that is used for global commerce everywhere because it's backed up by gold. And then when 1971 happened and all the gold was gone, there was 30 years of momentum and infrastructure and rails built for the dollar that it didn't really just having it not backed by gold anymore was not enough to stop countries from using the dollar. Now, the value of the dollar declined very quickly. One of the things that stopped the value of the dollar from declining was the agreement with Saudi Arabia to get them to only accept dollars for oil. So the United States went over to Saudi Arabia and said, "Hey, look, we'll protect you militarily, and your interests will be our interests militarily speaking, as long as you only accept dollars for payment for oil." And that was one of the things that kind of solidified the dollar as the global reserve currency, even though it wasn't backed by gold anymore, because countries now, if they wanted oil, most likely had to get dollars to be able to get that oil. And so now what we're seeing is kind of an unwinding of that, which it can take a very long time. And it's like you used to have to get dollars to do any international trade. And now, depending on who you're doing trade with, maybe you don't need to get dollars to do that. There's still a lot of momentum that requires countries to get dollars, mainly dollar-denominated debt. Like you're in Zimbabwe and you want to take out debt with another nation, you're not going to be able to denominate it in your local currency. When they were going through hyperinflation, you're only going to be able to get debt if you borrow money that you don't control. Otherwise, the risk is too high that you just print it to pay it back. And so countries around the world have a lot of debt, especially smaller countries. And that debt is denominated in dollars. They borrow dollars, so they owe dollars back. And they owe a greater number of dollars back than what they borrowed because there's interest on debt. And so the debt system has locked nations into, at least for the time being, you have to get dollars in order to pay back that debt. And so far, just deciding to default on that debt would spell more economic pain for that individual nation than anything, because if one little nation defaults on their debt, that hurts them. That doesn't take down the dollar. If everybody defaults on their dollar debt at the same time, then it defeats the dollar. But it's like, well, nobody's all doing that at the same time right now, because if just one does it, then it hurts them. So but the incentives are there. They're slowly moving, slowly rolling. Like I mentioned, all these little markers. It's like, okay, well, maybe I don't need dollars. And so eventually what happens to all those dollars? They, number one, become worth a little bit less and less relative to everything else, to all the stuff and other currencies, which means that people start accepting them less and less, or nations start accepting them less and less. The only place that will still be accepting them is the United States. So eventually all these dollars actually come back to the United States, because if Japan doesn't want dollars anymore, China doesn't want dollars anymore, and Europe doesn't want dollars anymore, well, you're not going to be able to send your dollars to somewhere and then get euros instead, because they're not going to want to give you euros for dollars because they don't want dollars. If everybody's trying to get rid of dollars, then you have to give them to somebody that wants them still, or that has to take them still, and that's the United States. So you're not just going to light them on fire and burn them. you're going to try and get something for them. And so they're going to come back to the United States in the form of a transaction, and the dollars are going to come back to buy our stocks, to buy our real estate, and to buy our inventory off of our shelves. And so all of the inflation that we've exported since 1945 eventually does come back here. So the question is, can we produce enough wealth to offset the slow flood of dollars that comes back home to prevent hyperinflation from that?
Do you think at that point, because no, we don't really know the time frame on this, right? Like this could be 100, 200 years away, or it could be 10 years away, right, Joe?
Yeah, I would say if those are the two choices, then it's going to be a lot closer to 10 years than
Yep.
200 years.
Hmm.
The reason is because when you track, like this is some work that Ray Dalio has done. For anybody who doesn't know, Ray Dalio is the largest hedge fund manager in the world. He's the founder of Bridgewater,
Yep.
and he's done a lot of research, like of the over the last couple 100 years of the rise and fall of nations, of economics, of power dynamics, and you can plot the rise and fall of great powers throughout the last 500 years, let's say, and then look at this the patterns of each one of those rise and fall of great powers, in terms of the factors associated with that. So there's there's education, there's military strength, there's it becoming the financial center of the world, issuing the global reserve currency, I think there's like 12 different factors,
Mhm.
and some of those things happen first that lead that nation to become a global power. And then some of those factors happen after, once the nation has become a global power. So things like education are leading indicators of a rising power, which makes sense. Like if your young people become some of the smartest and hardest working people in the world, then eventually that translates into your country performing well on the global stage. Once your country gets to that point where it's a global power, one of the things that happens after that is that you become the issuer of the global reserve currency. So the
Mhm.
United States became a global power during World War I and World War II. And it wasn't until after World War II that we issued the global reserve currency, the dollar, in 1945. Um, Before that, it would probably have been it would have been the pound. And so the fall is the exact same way, actually. And so when you look at the things that fall first before the power actually declines, some of those things are like education, which in terms of the United States, it's ranking pretty poorly on education these days,
Yes.
globally speaking, and that's one of the leading indicators. And then a couple of things that last the longest are that it controls the financial center of the world. So like London was still the financial center of the world for a while, even after the United States had replaced it. Um, the global reserve currency is one of those things that hangs around a really long time after the fall starts. And so when you look at those two things, and it's like, okay, stock market, wealth, currency, hedge funds, like Wall Street, it's like, yes, the United States still controls the global center of, the financial center of the world. And when you look at, okay, if a country's not going to use the dollar, what are they going to use? It's like the dollar's got a lot of momentum right now still. Even though there's little signs here and there, it's still got a lot of momentum. No country can just say, we're not going to use the dollar at all. When you look at those things and you say, okay, well, why? Like, what are the other factors that contribute to this? It's not the United States as a share of global GDP. It's not it's not a growing military presence around the world to help police the entire world. That's on the decline. It's not a growing trend of demographics. We've got less immigration now than we did. The trend of immigration is falling. Population is falling as a result of birth rates declining.
Mhm.
And so we've got all these trends moving against us. Yes, the world still uses the dollar, but it's like if if you only need to use the dollar because everybody uses the dollar, well, that's a sign that it's like, it's coming to an end. So I don't know how long this would take, and certainly some of these trends are reversible. And if the rest of the world gets a lot worse, faster than the United States, then the United States could still benefit because it's just relatively outperforming. And so, but I don't think there's a good case to be made for it to be, hey, this is a scenario where 100 years, 200 years down the road. I think it's probably, closer to the 10 to 20 time frame.
Yeah, and Ray Dalio lays that out really well. I listened to a lot of this stuff on YouTube with him, and I've read his books there, Principle, right? Or Principles. Yeah, he has
That's one of them,
two.
yeah.
Yeah, yep. Um, great stuff. And so talking about in debt and finance, the debt ceiling was just raised again yesterday. So that means more printing, more inflation. Is that right, Joe?
If I'm not mistaken, it wasn't raised. It was just the first stage of the negotiations passed. It was like the
Okay.
Republicans finally pushed through. They said, okay, here's the situation, like here's the bill to raise it. And if I understand it correctly, the Democrats are looking at that and saying, absolutely not, because the
hmm
Republicans are asking for too much.
hmm
And I don't think it even made it to Biden's desk yet. So
Okay.
um, it was the first step. Yes. Yeah, so ultimately though, the debt ceiling is almost certainly going to be raised.
Sure.
Um, because if they don't, then it's default, and it's like then everything we've been talking about. If the United States defaults on treasuries, it's like everything we've been talking about happens all at once. It's like
hmm
everybody sells treasuries and gets rid of dollars. It's not safe anymore. It's not an asset, um, and there's global turmoil, economically
hmm
speaking. So almost certainly they raise it, which means yes, more spending. But that's not necessarily inflationary, because you have to ask where the money is coming from that they're spending.
hmm
Are they
hmm
transferring that money from somebody else, or are they creating new money to finance their spending?
hmm in most cases, is it creating new money to finance the spending, or is it finding it somewhere else, or how does that work specifically? Because I always thought when the debt ceiling was raised, they were just printing more money to cover that, but that's not the case.
It's not always the case. Long term, it is the case.
hmm
But when you look at there's three ways that the government can finance its spending. The first one is taxes, which is a transfer. So
hmm
money comes out of your paycheck, goes to the government, and then they spend it, which goes into somebody else's bank account, whether it's a politician, a military contractor, Social Security, Medicare, whatever it is. Money goes from your bank account to somebody else's bank account, and everybody gets their cut along the way. So that's taxes as funding government spending. It's just a transfer, taking money from one person and then giving it to another. It's a reverse Robin Hood. So that doesn't increase the money supply, and the effect of that is not normally inflationary unless it has a destructive effect on wealth.
hmm
So if you look at a pizza that has 8 slices, um, and I need more slices because more people walked in to come to the party. I could take my knife and I could cut each slice into 2 slices. So now I have 16 slices. It's the same amount of pizza, but now it's 16 slices. So now I can give everybody a slice. Now, nobody's as full as they would have been before because the amount of wealth didn't increase. You just changed how it was measured. 2 slices equal one old slice. So that would be an example of like what happens with inflation. You just make more money, but you don't make more stuff. With taxes, that's like going around to, you've got 8 people, they each have one slice, and I'm going to take some of each person's slice to make one new slice and give to one new person. And so they actively see their slice decrease, and then somebody else gets it. Um, there's a chance that has a destructive effect on wealth. So there's an argument to be made. Okay, if you use that money to pay for education and infrastructure and beneficial things, then there will be a return on that investment, and people will, over the long run, will make more money, and so there will be a greater amount of wealth as a result of taking some wealth away from some people. I tend to disagree with that for the most part, but that's the argument. Now, very, very few people would argue that that's always the case. And so you can have that taxes destroy wealth by spending that money on something that doesn't produce more wealth. So a good example of this is, especially right now, and probably the last 20 years, military spending.
Yep.
By definition, it is destructive of wealth because you're taking resources, capital away from productive people, by definition, because the non-productive people are not paying taxes. So you're taking capital away from productive people. You are giving that to a company, a military contractor, that is using it to buy real resources like aluminum and steel and oil and all the stuff that they have to buy to make something that you'll have to spend resources on to go ship somewhere else for the express purpose of destroying it. Like, that's literally what war is. It's the destruction of wealth. Now, you can argue whether that's beneficial or not, or whether it's worth the cost or not. That hey, it's we need to do that even though it results in less wealth. Like, it's still important for us to do. Like, that could be argued, but the fact is that it is destructive of wealth. And so, let's say all of tax money was spent on that, then you would result in less wealth overall than you would have without those taxes being spent on that. So that's one form of government financing, is taxes. And if you have a destruction of wealth, that does result in higher prices, even if you don't have more money. Even if there's even if the money supply stays the same, it's like I literally just take a piece of pizza and throw it in the trash. There's less pizza now. It's like that's what happened. And so you need to get the same amount of pizza, you'd actually have to create more pizza. So the slices are they go, in terms of price, they go up. And so that's one way that you have inflation from taxes. The second form of government spending is from borrowing. Mm-hmm. And when I borrow from you, it's still a transfer. So if I borrow from a bank, if I borrow from a pension, if I borrow from a retiree, if I borrow from a saver, whoever I borrow from, it's money coming from Aunt Sally. And again, just going into that pool of wherever the government spends money on. And so that way can either be beneficial or not, depending on how the government spends the money, but it's still just a transfer of money from one person to another. Now we get to a point where, like, right now, the government's at this place, like over the last couple of years, where there wasn't enough cash in the system for them to borrow from people or for them to tax it all from people. They wanted to spend $3 trillion extra dollars. They couldn't borrow that and they couldn't tax it. The money wasn't there. So they went to their buddies over at the Federal Reserve and they said, print us up $3 trillion. And so that's where you get the inflationary financing from, is from the Federal Reserve printing for the additional borrowing, because they wanted to borrow an extra $3 trillion. There wasn't enough, so that had to be printed. That's what causes the majority of the inflation, when you have a big spike in the money supply that finances the borrowing. Mm-hmm. Right now, that's not happening. When you look at the money supply, it's actually decreased over the last year and a half. It's less. There's less money in the system now than there used to be a year ago and a year and a half ago. And that's because the Fed has been doing the opposite. Instead of loaning money into existence, they've been allowing that debt to get paid off, which takes money out of circulation. And so there's less money in the system right now. So as the government is spending money right now, they're spending money that they're just taking from taxes and borrowing. It's not money being printed into existence. And so right now there's no inflationary financing, but the question is, when is it going to come back? And it could come back very soon.
It seems like all three of those options that you just laid out really clearly, none of those are good, right? Like, taxes go up, right? That's option one. They take it from taxes. We borrow more, assuming there's interest there. We're paying other countries, or we print it and then inflation goes up. So what I'm seeing is, like, we have to, and I'm sure you agree on this, is we have to reduce spending by 80%, right?
Honestly, I know it sounds crazy, but even going back to 2019, let's say they only spent the same amount of money that they spent in 2019. We'd have a budget surplus. Surplus, not deficit. Surplus, not even a balanced budget, a surplus. So it's definitely not an income problem. When you look at the amount of money the federal government receives every year, it goes up just over the long term. It's just a
Mhm.
straight line. There are a couple periods where it's like, hey, the government got less money this year. Like probably the money they received this year from 2022 taxes will
Mhm.
probably be less than what they got in 2022.
Mhm.
But over the long term, it just goes up. So it's not an income problem, it's a spending problem. And like I
Yep.
said, if they just spent the same money they spent in 2019 or 2018, which was still way too much, trillions of dollars, like they're
Mhm.
massive amounts of money, they'd have a surplus instead of a deficit. And so they could start to retire some of that debt. Um, Now, there would definitely be other problems as a result of this, but it's not a question of ideals. There's no possible scenario in which there are not trade-offs. That's what the problem of economic calculation is, and the problem of scarcity. It's that there's always a trade-off. So it's not that, would it be better for this person over here to have somebody pay for their education so that they can get a better education and make more money? It's like, you could probably make a good argument for that it would be better for that person if they could get that education for free rather than having to sacrifice for it. You could probably make the other argument the other way too, but in either
Mhm.
case, it's like that might be a good thing. But what's the trade-off? It's like, okay, in order to do that, there's no free lunch. The purchasing power has to come from somewhere, and if it comes from inflation, the purchasing power comes from the poorest, because that's who
Mhm.
gets hit
Yep.
hardest by inflation. It's the savers and the wage earners. And so it's like, should we take purchasing power from the poorest people to fund the higher education of somebody who probably has two working parents and can get a job to pay for it themselves? Well, probably not. That's probably not a good trade off. Okay, well, what if we fund it through taxes instead of inflation? Well, who are the taxpayers? The taxpayers are the producers, the people who are out there like earning and saving and investing and actually producing for a more abundant future. So, should you take from somebody who's a proven producer and risk it on somebody who might be just wasting it away and joining, a fraternity and partying all year long for 4 years straight and not learning anything, and then that there actually is no ROI and they're stuck in a dead end job now with $100,000 of debt that you can't even get out of through bankruptcy? It's like, well, that might not be a good trade off either. So we don't have to go all anarcho-capitalist here and completely eliminate the federal government, or go, completely bottom up and have the states start seceding from the union and completely dissolve. I would like that, but nobody else wants that. And so all we have to do is go back to 2018. How about
Mhm.
we have to decrease the deficit by 5% every year?
Mhm.
How about we have to, if the government runs a deficit of more than 2% in a year, it automatically disqualifies any sitting politician from reelection for the rest of their life. It's like, little changes produce big results long term. For the last 50 years, we've been making little changes in the wrong direction, and that's why we're in a mess. If we start making little changes in the right direction, it'll add up over time. It'll compound over time.
Oh, you laid that out really, really well. That's some pretty mind blowing information there. It's cool knowing, that we could get out of this if some of those measures were in place, right? I didn't think it was. I thought it was. It is bad, right? But it's something that could be fixed for sure.
Mm-hmm. Yeah,
Yeah.
definitely.
So.
It's not unfixable by any stretch of the imagination. It would just require a little tiny bit of sacrifice. Like every single part of the government budget, like cut it by
Mhm.
5% every year. Like cutting it
Yep.
by 5% every year is not going to be devastating to anyone.
Yeah. So here's the big question: how can families protect their wealth in turbulent times? I listened to almost all of your podcasts. You have an amazing podcast, but not all of our listeners listen to the information you put out there. And how middle class families, young kids, how do people protect their wealth in these turbulent times and possibly even grow it? What would you recommend?
Yeah, I would recommend a few things, and it depends on kind of the stage that you're in. So, I would say stage one is like the young person with very little experience and no wealth. I would say, as much as possible, what you want to do is avoid handcuffs.
Hmm.
So, So like specific, like this is something I my kids, my son is 7, my daughter's 5. Like when they get a little bit older, like this is the stuff I'm going to start telling them. It's like college may be worth it if you can pay for it. And if you can pay as little as possible for it, like community college and stuff, trade school probably better. Absolutely no debt for that ever, because if it hits the fan, it's like you can't ever escape that debt. You can't get out of student debt with bankruptcy. It's the only debt that lasts forever that you can't get out of. And it's if you have to get debt for it, then the ROI is not going to be there. The time it takes you to pay that back, it's like the college degrees that are the most expensive. Yeah, you're going to make a little bit more money in those jobs, like a doctor or a lawyer, but it's like the time it takes to repay that and then start to actually gain ground in the future is probably not going to be worth it, especially considering what you're giving up by the other options are going to have a much higher ROI. Like you start off in a career learning a hard skill early on, like I personally know friends of mine, plumbers, making decent six figures.
Oh yeah.
North
Yeah, me too.
of 200 grand. You're literally a plumber, like something that like a lot of people, like highly educated people, would look down on. And it's like they're making more than you, and they don't have any student debt.
Yes.
So
Yes.
those kind of things are not going away, especially as you get into harder and harder times. It's like the physical, the real stuff. The real businesses are things that there's always going to be a need for that. Like physical stuff always breaks. So that's one thing, is like learn how to learn a skill that will always be in demand, that is a high paying skill that you don't have to pay a lot of money to acquire. You might have to pay time. You might have to pay, in terms of concentration and education, self-learning. There's a lot of these things you can learn on your own. If you want to become a marketer, don't go get a degree in marketing. Watch YouTube videos. They'll teach you 10 times as much about marketing than any degree ever will, where you're learning from a professor who learned from a professor 70 years ago about marketing. Absolutely useless.
That never ran a company or never marketed services for sale themselves.
Exactly. Yeah. And so some of those hard skills, sales, marketing, are always going to be in high demand. Just don't get debt in order to get those skills. And have a mindset of, I always need to increase my income. At least for the first 10 years of your career, and focus on skills that will, come together to help you increase your income. So that's one kind of person that I would focus on with that advice. Then I would say to somebody who's like, I would, like my parents, or older than that demographic, where it's like, hey, I've worked a long time, I've saved up, I've got a 401k, I've got a 403b, I've got a TSP, I've got a pension, I've got a little bit in savings. What should I do? Should I start trying to pay off my house? Should I invest differently? Should I invest in stocks? Should I invest in bonds? It's like, I don't have enough to retire. What do I do to protect what I currently have? And I would say somebody like that is probably the biggest need is going to be financial education, because you've done well at like having income, and you've had a job and you've had a career and you've built up a little bit of a nest egg, but you don't know what to do with it. So you need to start learning about how money works. Start learning about how inflation works, where inflation comes from, what deflation does. And then you can start preparing for that. So, because we might be entering into a time of a short period of deflation, we might be entering into a time of protracted and long-term inflation. And so, personally, if I was in a situation where I was getting to the end of my career and I had a little bit of a nest egg, I'd put a decent amount in gold, probably, I don't know, anywhere from 5 to 30%. I know that's a big range, but I want to have savings to draw on. And I would view gold as savings, because for thousands of years, the purchasing power has been the same. So I'd put a good chunk in gold. I would put a very small chunk in Bitcoin, because if things get crazy and money starts being Bitcoin everywhere, it's like the price of Bitcoin has to go up. And so that's like a call option, or I would say a put option on the dollar. And in terms of stocks, I would probably start learning a little bit of fundamental analysis, making sure that you're invested in stocks that have reasonable valuations.
Mm-hmm.
Um, Become a value investor for stocks. In terms of bonds, I'd probably stay out of them unless you're a short term trader. There might be a good opportunity for very short term bonds right now, just kind of as a trade. But I personally don't want to be in something like that. A lot of risk of default and not a lot of return when you account for inflation. And so I'd rather be in something like gold for my savings rather than bonds. And then for real estate, if I could get a 30-year fixed, I'd probably not pay off my mortgage.
Mm-hmm.
Um, I'd probably, if I'm buying more real estate, be a little bit more heavy on the equity side, put a little bit more down. And then if interest rates do come down in the future, then I can just refinance. People are scared of real estate right now. So I might be trying to pick up rental properties that have cash flow right now. If I can't
Mm-hmm.
have them cash flow for me, then I'm going to stay away from them. So with the interest rates high, that's going to be a little bit difficult, but you might have to put a little bit more cash down. But that's going to be something that's going to be good for you for inflation. And so a little bit of everything of all the above there. But it's going to start with reading books and becoming financially educated.
Yeah, we need to be doing more of that in the school system. You mentioned these young kids going out and getting degrees and stuff. We don't do any financial education in the schools at all. I see that being a huge problem. I know Robert Kiyosaki talks about this a lot. And so, you have these young adults coming out, buying new cars, getting huge houses. They're putting the handcuffs on, like you had said. They got big student loans, and now before they know it, they don't have options. They gotta work in a job they don't like, make as much money as possible just to break even though they may be making a modest to pretty good income. And
Yeah.
yeah, that would for me, that was a huge light bulb when I started following Robert's work was, spending less, making more. And, we
Yeah.
see today, these even middle class families, like they make pretty good money, right? But they spend a shitload.
Yeah.
And, they've got the RV, they've got all the new snowmobiles, they've got all these depreciating liabilities sitting in their lawn. They've got 30 more, years on their house because they did home equity loans. And it's just all these, variable rates are just leaking money everywhere. So, yes, I think it'd be great, make lots of money, but I think you also have to not only put it to use by purchasing, assets that cash flow, but also spend less.
Yeah, I mean 100%. That especially for young people, that's something that I didn't even touch on because there's two camps. There's like I would say there's like the fire camp, financial
Mm-hmm.
independence, retire
Yep.
early. I think them and like Dave Ramsey and there's a group that's like all about just spend less.
Yep.
But if you're making $30,000, you cannot spend less
Yep.
uh, to make a dent on anything. It's just not possible. So you have to earn more. But like you said, there's a lot of people who have focused a lot on that earning more. Like I would say like a lot of high earners, lawyers, doctors, middle managers, like things like that. They've got great incomes and they've never learned the discipline about what to do with that money.
Mm-hmm.
And so it's one coin. Both sides of the same coin matter just as much as the other one. Uh, uh, Spend your money on assets and then earn more. And if you're spending your money on assets, that means by nature you're spending less on garbage. And so make more and then spend it on the right things.
Mm-hmm. Yeah, that's great. This has been a great talk, Joe. I always like having you on, buddy. Any
Yeah,
other
thanks for
things
having
you
me.
want to share to our audience here, or we'll wrap this up?
No, I'm everywhere. So if anybody's interested, I'm on YouTube, podcast, Twitter, TikTok. So anywhere you're at, I'm putting stuff out.
Awesome. Yeah, Heresy Financial. We're gonna put all your links, like normal, in the description there. We'll spread that out and keep educating people, Joe. That's what this is about. And then there will be hope. There will be positivity.
Absolutely. Thanks again for having me.
Okay. Thanks, Joe.